The US Central Bank has pushed interest rates to its highest level in almost 15 years as the bank fights to rein in soaring prices in the world's largest economy. The Federal Reserve announced it was raising its key rate by another 0.75 percentage points, lifting the target range to 3% to 3.25%. Well, let's get more on this now from Nina Trentman, who's a bureau chief at the Wall Street Journal in New York and manages its corporate finance coverage. Nina, what do you make of the move?
Well, it was to some degree expected. We did expect at least 75 basis points. Some were even expecting 100. This is the third in a row, and Jerome Powell today indicated that there would be more rate increases to come as inflation remains relatively high, even though it hasn't risen further over the summer. So to some degree, this was an expected move. Markets did anticipated by selling off quite significantly in recent days and even also in the past week. So this is something that people have been planning for and will probably continue for a while longer.
They've been planning for it. Will it work?
That's another big question. If you're Jerome Powell, then of course you think it will, and chances are that it will. Question is more not so much will it work, but when will it work? Because of course we've seen the Fed, when it entered this year, we were at basically zero in terms of interest rates, or near zero here in the US. And fast forward a few meetings from the Fed, we are at higher rates that we haven't been at for 15 years, as you said. And so the pace with which the Fed has been responding has been fast, but also the pace with which inflation over the past year has increased has been significant. And so question is also, how will the labor market respond? And will the labor market at some point slow down significantly? And will we see higher unemployment rates as we're seeing now? Because so far the unemployment is still at a reasonable level. It's not at levels yet where you would expect the economy to automatically go into a recession, even though we've also seen 2 quarters of contracting growth here in the US. So there is this feeling of there being a slowdown. We're seeing companies making selective job cuts. We're seeing companies refinancing at higher rates, therefore seeing higher financing costs. So the picture is certainly one of a slowdown in growth, but inflation so far hasn't really slowed markedly. In the past month, we saw it at 8.3, down from 8.5 in the summer, which is to some degree a decline, but year over year, it's still very elevated. And what I hear from companies and from CFOs is very much that people expect high inflation to be a feature at least for the next year, if not longer.
And we saw President Biden, didn't we, the other day, trying to defend that high inflation rate, suggesting that it was some sort of achievement, the fact that it was static. And when we look at these rate rises, what kind of international effect might this provoke, given the fact that so many other countries will be looking to see what the United States does?
Well, we've seen other countries around the world follow suit to some degree. We've seen the Bank of England do this, increase rates. We've seen the European Central Bank do this. We've also seen other countries around the world sort of maintaining lower rates. But of course, the big thing that this causes is further increases in the US dollar, which is something that influences economies all around the world in very many different ways, given that it still has a very important impact on the global economy. So that's something that we've seen in the past year, a significant increase in the US dollar compared to other international currencies as the Fed has tightened its monetary policy. And so that's something that we're expecting to continue for a while longer.
Nina Trentman from the Wall Street Journal, thank you so much for joining us.
Thank you.